Hello, and thank you all for attending today. I think we're starting a couple seconds early, but it seems like everybody has logged on that we were looking for. But I'm Pat Seaman. I'm with Seaman Retirement Planning. Today, we're going to talk about how elections and politics can affect the stock market with our guest, Tony Parish, who's with us here today. Um, so again, we have Tony here today, and I tell you, I am so happy to have him as a guest. Tony is the Chief Investment Officer of Alphastar Capital Management, a really smart guy, kind of with a natural gift to explain the most complicated of topics in the world in a very understandable way. And I think he keeps it pretty entertaining. I've been working very closely with Tony since 2019 when he started with Alphastar Capital Management. Now, Alphastar is our investment advisory firm. They're out of Charlotte, North Carolina, and Tony oversees and guides Alphastar's investments and their managed portfolios. I'm sure he could add a few more things to that, but Alphastar itself manages about $2 billion in assets and works with hundreds of independent investment advisors such as us across the United States. So, Tony, I asked you to join me today to discuss how politics and presidential elections can impact the stock market. I know that you prepared a few things to go over, so I'll go ahead and I'll turn this over to you.
All right, Pat, thanks very much. I really am delighted to join you all today. I know that everyone is busy and you have choices about how you spend your time. So I'm grateful that you've given us some time to talk about politics and the markets today. This presentation, I've got a few slides here, but really I'll kind of speak mostly off the cuff. This presentation that we're going over is really a subset of a larger presentation that we put out on a semi-annual basis called the State of the Markets presentation. Our agenda for the full State of the Markets presentation, which we won't go over today, is as follows. But the second part really looks at the top three topics on investors' minds. And the top three topics on investors' minds in the second half of 2024 are the economy, inflation, and the elections. And so we're going to talk about elections. This is a supercharged topic in people's minds, right? Everybody's seeing political ads on TV, and they're probably getting you're getting political ads sent to you via text message on your phone and through Facebook and social media and on the radio, and people are talking about politics. Every 4 years, the political conversation really ramps up. In fact, every 2 years it ramps up, but especially during presidential elections. And there is a lot of discussion about how elections affect the markets. And that's really what we want to focus on today, specifically the stock market. So what we see on this slide is a chart of spending to elect U.S. presidents from 1984 on the left-hand side of the chart up until 2020. So U.S. election cycles, there's nothing that you take away from this presentation other than this. That will be okay. The most important point, the most important takeaway is that U.S. election cycles represent a massive spending machine with one goal in mind, and that is to convince voters to vote in specific ways. So as this chart shows, from 1984 through 2020, the last year of full data, spending to elect U.S. presidents has increased more than 1,600%. Shaping voters' minds is big business. And this massive ad campaign creates a lot of allegations that elections drive markets and that the outcome of elections drives markets. Unfortunately, and this is me, being honest, I wish I could give you a different story, but unfortunately, we have found that most of this analysis that alleges that elections drive markets, most of the analysis is really just political propaganda disguised as investment advice. And the analysis disintegrates, in fact, when it's exposed to objective scrutiny. In a moment, I want to look at a couple of myths that have been created and really kind of unpack the myths a little bit. But I do want to share a statistic before I do. I saw a news report today. Today's the 15th of August, 2024. And this news report showed political spending in the month of August, from August 1st through the 14th, yesterday, and compared that to 4 years ago and compared that to 4 years previous. So political spending this year, August 1st to 14th, in the elections has been $280.8 million. That compares to 2020, where the spending was $245.1 million, an increase of 15%. And if we compare to this year's spending to 2016, just 8 years ago, that amount was $62.3 million. Spending has increased 351% over the last 8 years to elect, in this election cycle. So again, I want to point out, election spending has one goal in mind, and that is to convince voters to vote in specific ways. Let's look at a couple of the what I call myths associated with political spending and the markets. The first myth is that election years are better for the stock market than non-election years, right? You may have heard this. I certainly have heard it. I've heard multiple people talk about that. Election years are good for markets. Well, if we go back to if we look at the data, and we really ran the data going all the way back to the inception of the S&P 500 index in 1957, which for you historians out there was during the Eisenhower administration. If we go back to 1957, we do see that the index, the S&P 500 index, has a slightly higher track record of delivering positive returns during election years than it does during non-election years. In other words, if you only invested in election year, you had a slightly higher probability historically of generating a positive total return relative to if you had only invested in non-election years. The difference is small, but it's possibly significant. There may be some statistical significance there. Unfortunately, the average total return during election years historically has actually been slightly lower than it has been during non-election years. So this is represented in this chart. The dark blue bars represent the proportion of years that had positive returns above zero. And you see in the election years on the left versus non-election years on the right, the dark blue bar is higher in election years, meaning there was a higher probability of getting a positive return than it was in lower election years. But the light blue bars show the average annual total return, and you see that the light blue bar is lower in election years than non-election years, which raises the question, would you rather have a slightly higher probability of a slightly lower return or a slightly lower probability of a slightly higher return? Once you begin to look at the data behind allegations such as elections are good for the markets, you begin to realize that that's a gross oversimplification. We cannot come conclusively away from the data and say that elections are good for the markets. It's just not true. It sounds good. It may look good on a bumper sticker or on a political banner that somebody's holding at a rally. It's just an oversimplification and therefore shouldn't be taken as any kind of investment advice. Let's move on to the second myth. Another myth is that one party is better for the markets than another party, right? Republicans say that Republicans are better for the markets, and they say if you vote for a Democrat, your investments will go down or not do as well. And Democrats say the exact same thing, but they say that they're the good team and the Republicans are the bad team. What do the data say? Well, the data say that if we go back again to 1957, seems like a long time ago, but let's just keep in mind, going all the way back to the Eisenhower administration, that's just 16 presidential elections, right? Because presidential elections only happen every 4 years. So we really only have 16 data points, 16 examples of elections to use in our analysis. And any of you out there that remembers, high school statistics, you're going to remember that using a sample size of just 16 is statistically unreliable. It's tiny, and looking back at historically, we can find some time periods where stocks perform slightly better when one party occupied the Oval Office. And what we have on this slide is the average total return of the S&P 500 when we've had Republican presidents on the left bar, S&P total return when we've had Democratic presidents in the middle bar, and then S&P total return for all years in the right-hand side. When you see bars, or when you see charts such as this, They may seem compelling, but you have to keep in mind that we're using an unreliably small sample size. And unreliable sample sizes, small sample sizes, they're vulnerable to cherry picking and distortions and oversimplifications. In other words, they should not be viewed as valid. Yes, we can find, looking at the statistics, it may suggest that Democratic presidents are better than Republican presidents, but I would honestly throw that out the window. I just don't believe that it is statistically reliable. If you dig deeper into the analysis of what were the factors that actually influenced the markets during those years, you quickly realize that the main drivers had little to do with the political administration at the time. Markets are much more focused on earnings and on the economy and on fiscal policy, and monetary policy than they are which party is occupying the White House or which individual is occupying the White House. In short, the relationship between presidents and markets is weak at best, despite all of the political spending that's designed to convince you otherwise. So, sure, there are some expected market differences between the two parties, and we can, talk about them here. But in the grand scheme of things, the differences are marginal. They're differences of degree rather than differences in kind. Both parties seem to support tariffs, which I personally believe is terrible policy. Tariffs didn't work in the 19th century. They didn't work in the 20th century. And in my opinion, they're not working in the 21st century. Tariffs really just equate to taxation on our population, because we, the consumers that are buying the products that have been hit with tariffs, are paying a higher price for those products than we would be paying if there were no tariffs. But both parties are supporting tariffs, and both parties are supporting large government spending. Neither party officially is talking about reducing government spending, reducing the government debt. So both parties are really focused on the same issues there. Democratic initiatives tend to focus more on higher corporate taxes, tighter corporate regulation, and more liberal trading policies with our global trading partners. Whereas Republican initiatives tend to focus more on lower corporate taxes, looser corporate regulation, and tighter trading policies with our global trading partners. Each one would help certain segments of the economy and hinder other segments of the economy. For instance, Democratic initiatives tend to focus on clean energy and electric vehicles, solar energy, et cetera, possibly the cannabis industry. Republican initiatives tend to focus more on oil and natural gas and perhaps the cryptocurrency industry. But can we realistically say that one will be better for the markets than the other? No, we cannot say that one will be better for the markets than the other. Markets are much bigger than any party or any president. And we encourage you and all investors to try and filter out the noise that you're being bombarded with that alleges otherwise. Now, there is one thing that's important to point out, I believe, and that is, even though the specific party that's in power, we cannot say will affect the markets one way or other. What we can say is that uncertainty does affect the markets. When there's uncertainty, as we're seeing now, and we will continue seeing up until the elections, uncertainty causes volatility in the markets. We've really seen this over the last few weeks, really since the end of July, beginning of August. These big, up days in the market and big down days in the market. There's a lot of choppiness in the market now that we're seeing, which we didn't see earlier this year. And we should expect to see that between now and November when the elections come. That has more to do with the uncertainty of the markets and the uncertainty of the election, as opposed to any likelihood that one candidate will win over another. Here's the key takeaway. It's important for investors to not be reactionary in the face of this uncertainty. It's important for investors to work with Pat, work with Jim, work with your financial advisor to make sure that you have the right plan in place for you, knowing that there will be bouts of uncertainty. Uncertainty rises, uncertainty falls. It is cyclical in nature. And it's important to not change your plan based on the headlines or what you're hearing or what you're seeing. Make sure that you have the right plan in place to be able to ride out the volatility when it happens and make sure that you have the right investments, the right balance of stocks, bonds, insurance products, what have you, to facilitate your long-term financial goal and your long-term plan. Don't react to the volatility. Know the volatility will happen. It will happen in times of uncertainty, such as elections. It doesn't have to do with the candidates. It has more to do with the election cycle itself. Have your plan in place. Stick with your plan. Work with Jim and Pat to make sure that you have the right plan in place. So those are the topics that I wanted to talk about. I want to summarize it here in the following few bullet points. Elections are big business. Investors should ignore politics disguised as investment advice. The relationship between U.S. elections and the markets is tenuous at best, and markets are much bigger than any president or any political party, despite all the propaganda that's out there to convince you otherwise in this election season. These are the disclosures that our compliance team wants you to know. And with that, I want to thank you for indulging me in these prepared remarks about how politics and the markets are related, or as the case may be, unrelated. Pat, I'll send it back to you.
All right. Thank you so much, Tony. That was great information. I was kind of thinking I might find a chance to interject something and challenge you, but there was just nothing there. It was perfect as usual. So, but I do want to thank you very much for taking the time and talking to us today. If you have any questions for you in the audience about this topic and would like to learn more, always feel free to give us a call, shoot me an email. We're here for you. I'd also like to take a minute and just announce that Tony will be coming to Canton for our annual State of the Markets event. This is going to be on October 29th. It's at Don Shula's restaurant, which is at the Pro Football Hall of Fame. If you'd like to attend this spectacular event with a fabulous dinner, I might add, that will be provided, please email or give us a call. If you're not a client, if you'd like to learn more about this topic or our planning process, we do offer a free 1-hour consultation, which will help you see if we can add value or help you in any way. Again, just send us an email or call us, give us, just contact us any way you'd like. With that said, I'd like to thank everybody for attending. We hope that this webinar was helpful. And with that, that concludes our webinar.